Every squeeze trader has heard the same advice. Wait for the pullback, you will get a better entry, do not chase. I've taught that for many years myself. Wait for a pullback to the market pulse line. But I finally took a look at 455 of our slingshot squeeze signals, and I actually checked these manually to try and see is there some common pattern. And there is a hole in that advice of the wait for the pullback advice. And that hole, if you have been following it, has probably cost you some of the best trades this year. I'm going to share the research and the results in this video. If there's more interest, we can expand this to more symbols and a larger historical period. For this video, we're focusing on 455 signals and about 600 stocks and ETFs going back the past 2 years. Now, before we talk about results, I want to share a little foundation for how a squeeze trade works, especially if you're new to squeeze trading. When a squeeze trade actually starts to build up, we see these red or black or yellow dots on our screen. Now, for the entry for this exercise, I used our slingshot squeeze signal. And when that slingshot squeeze occurs, or when you see this arrow trigger, the squeeze is still very much in this building stage. So we would call that this compression stage in which the stock is still coiled up, it's compressing, and that's the time where you're looking for an entry before that energy actually releases. Now, when that squeeze finally fires, that's what we use for our exit. That's what we see as the green dot, and that's where we're looking to take either profits or losses if the squeeze is fired against us. So if you were to really zoom out, all of the action really takes place in that window in between. Now, in that window, a stock does one of two things. A, it either dips back towards your entry first, so it gives you this pullback, allowing you to get a better entry price than even the closing price of when we saw the slingshot squeeze. Or B, it starts to run right away, and we see the momentum kick in, never really getting a chance for this pullback. Now, the wait for the pullback advice only works if you actually do get the pullback. That's quite obvious, at least it should be. So the real question you should be asking yourself is how often then do we get this pullback? Is it happening on nearly every trade, or is a pullback actually something that's a little bit more rare? So let's start with answering that question first. Out of the 455 total setups we were looking at, about 40% of them, so that means 179 setups, never pulled back, not once. They ran straight from the signal and they ended up hitting the target. Now, from these actual trades that we missed, so the 179, they won about 92% of the time. So in that group of trades that we missed, there are actually a lot of winners. And most of these winners ran for about a +6 to a +7% move in the actual underlying. So if you were waiting around for a dip, you actually missed a lot of these incredibly nice winners that were some of the nicest winners of this year, simply because you were just waiting for this pullback that never came. Now, I figured, based off of this, the next logical step in my head was the ones that do pull back, they've got to be at least the better trades. You're getting a discount, you're getting a cheaper entry, and hopefully with that, you're mitigating your risk a little bit. That was the whole logic in my head. Now, these trades won about 49% of the time, which was still a coin flip. And the typical one, the median pullback trade, actually lost money if you were to look at all of these measured on the broad scale. Now, here's what I think the pullback doesn't actually tell you is sometimes that dip is a gift, but a lot of times what we saw, or at least through this exercise, is that dip was the first crack in a move that was already falling apart. And in the moment, you can't really tell which one you're looking at. You don't know if this is a trade or a trend that's starting to fall apart, or if this is just a buy the dip sort of setup. And if you've been trading for any bit of time, you know that that's usually where the deer in the headlights feeling starts to kick in. So look at the actual trade you are making when you wait. You are throwing back that 92% pond to go fishing in this 49% pond. That would be a different way to look at it, all for the slightly better price, quote unquote, being a dick for a tick. You're filtering out your winners to get a discount on your losers, and as you can see, the data shows us very clearly that waiting for the pullback does not improve your entries, it just deletes 40% of your trades, and specifically, what we found, some of the best trades are encompassed in that 40%. Now, I want to be careful here because through all of this, it almost sounds like I'm saying pullbacks are a bad idea. That's certainly not what I'm trying to say, and I'm surely still going to be waiting for pullbacks myself. For the stocks that do pull back, entering on the dip still gets you a better entry price than chasing. And there's personalities of stocks in which buying the dip is inherently better than actually buying the pullback. It's part of the side in which that actually wins more often. Take those same dippers, and if you were to say reverse this and you were to chase those trades, they would actually do worse. In a lot of these cases we saw, they tend to lose about 3% on average if you take this slightly aggressive entry versus having bought the dip. So there's very much another component here about knowing what is each individual stock's personality and knowing, is this stock one in which you want to wait for a pullback or one in which you want to simply get in because it tends to be a runner. Now, how do you take all of this and summarize it? What do you do if we know that, okay, pullbacks have this one direction, runners have this one direction? How can we get the best of both worlds? Well, when the slingshot squeeze signals, that's your sign that, hey, the squeeze is starting to build. We have some level of edge, especially when we backtest it and we find that the signal backtests well. The best way that I've found, put on a starter position right then and there at that exact time. You're not worried about a pullback or any of that nature. Even a small size if you want, but this allows you to still participate in some of these runners that otherwise you would never catch. Now, if you do get that dip, then that's where the better entry price is, and it allows you to add to your position. However, as we can clearly see, there is some merit to entering this position right away instead of predicting that you will get a pullback. More often, we've seen that a lot of these best winners, if you will, from the year tend to come in these runners that you want to have some stake or position in. And to be straight with you, so far, this is just 455 trades over 2 years. It's a relatively small sample size, a very real sample size, but a small sample size. I'm already working on a larger version of this that there's just a lot more data that we're combing through, but I want to see, is the same exact idea, the same theme still holding through a much wider lens period of history, through different market transitions, through markets, bull markets, bear markets, and everything in between. I'll be sure to share that research if this is something you find interesting, but I did want to get this on your radar. We always think buying the dip is a good idea, but hopefully through this video, I was able to show you that buying the dip is not always necessarily good. In fact, sometimes it's better to be entering right when you see the actual signal to be able to participate in these larger runners because they tend to make your account and show some of the largest gains at the end of the year. More to come with this research. This is just the beginning. Hope you found this video helpful. For those of you that are squeeze traders, take care everyone, good luck, and I'll see you in our next update.